Hello, I'm Richard Murphy. I want to talk about something that I've known for a long time, but which most people do not realise, and that is that the published accounts of multinational companies are, for all practical purposes, works of fiction. Now that's quite a big claim, but I suggest, and this is something that my friend Professor Prem Sikka, now a member of the House of Lords, agrees with, that in practice it would be entirely possible to submit one of these sets of accounts to a literary prize and actually have pure justification for doing so. Let me explain why. These accounts that are published as if they are those of the organisation that issues them are simply not a representation of the transactions that the company in question has actually undertaken. Remember that large multinational corporations are not single companies. They're made up of hundreds and very often thousands of individual companies, all of which are in some way or other deliberately under the control of what is called the parent entity, which is the one that issues the accounts. But it is very rare indeed for that parent entity to actually trade with anyone. It normally simply owns the shares in what are called holding companies, which in turn own the shares in the companies that might actually trade. So for example, if you trade with Tesco's, you will if you go to one of their stores, you don't trade with Tesco's PLC. You trade with a company called Tesco's Stores Limited, and that actually owns the UK shops that you might go and buy from. So the transaction that you might have undertaken with a supermarket does end up reflected in the accounts of the parent company, and yet it never actually partook in it. You dealt with someone else. Now, does that matter? Well, yes, it does. Because what we are led to believe by accountants and by the organisations that are responsible for setting accounting standards is that it is these accounts of the parent company of these multinational corporations that are what we need to appraise its financial performance. And they tell us that this information is sufficient to meet the needs of all the stakeholders of a company. Now, that quite simply is not true. Who are the stakeholders? I suggest there are at least 6 stakeholder groups, although frankly I'm beginning to move towards a 7th, because the first group is called the suppliers of capital to a company. Now, they are the shareholders and the people who lend money to the company. But I now begin to believe that the shareholders have such distinctly different needs from the other suppliers of capital to a company, who are basically those who make loans, like banks and bondholders and so on, that they should be considered separate groups. And then there are the other stakeholder groups, the first of whom are the trading partners of the entity, the people who supply it with goods and services, and of course us, who might become the customers of it. And we all have an interest in the financial viability of the companies that we deal with. If we're selling to it, of course we want to know that we'll be paid. If we buy from it, we might well have guarantees and other obligations from it that we want to see fulfilled. Then there are the employees, past, present and future. Past, of course, because of pensions, present because they want to know they're going to be paid, and they want to know that their pay is fair, and they want to know that there are things like gender and race equality and so on within the payment structures of the organisation. And future because people may want to determine whether the company they might work for is fair and also is likely to pay them. Then after that, there are regulators. Now, regulators have very particular needs for information on organisations. Are they complying with health and safety or international trade rules or whatever else might be their concern? And accounts help them select the companies that they might well want to look at, because what regulators know is that very often companies seek to shift their responsibilities across borders to avoid regulations in one country and get a lighter touch in another. Well, another group who have the same sort of interests and who are the next stakeholder group are tax authorities, not just in one country, but in all the countries, and indeed all the types of tax authority that are dealt with in one country. Because, of course, even inside the UK, there's more than one tax authority. There are local authorities and regional governments, all of whom might have involvement in the whole process of collecting tax from these organisations. And finally, there are civil society. Now, civil society is a wide description of everybody from those local authorities in their role as regulators in particular, but also as people who provide planning permission, but down to people like, well, you and me, if we're concerned about a company, those who have concern about the environment or fair trade, those who have concern about tax justice, and academics and researchers, and of course the media, who will, we hope, help hold companies to account. All of those stakeholders, except perhaps the providers of capital to the company as a whole, have very good reason for wanting to know information about what happens in the subsidiaries of the public interest entity, which is what multinational companies are now beginning to be called. PIEs for short. Public interest entity equals PIE. And they will not only want to know what happens in the subsidiaries, but they might want to know about what the entity does as a whole in the place where they are. But there is no such information available in most multinational accounts. If you're lucky, there will be a list of where the subsidiaries are, but not where they trade, and there will be no indication of how they are owned through the hierarchy of the group structure of the organisation. So it will be virtually impossible to work out what the relationship between these various entities is and how they contribute to the overall figure that we get. And there's one very important point to remember still, and that is this. All those entities that make up the public interest entity, the PIE, will trade with each other. Why? Because, for example, if we go back to a supermarket, they might well source goods from another country. It's very common, for example, for multinational groups of supermarkets to have a sourcing company in Hong Kong who will buy materials from China. Could be somewhere else, but you get my point. There will be subsidiaries used for the flow of goods and services around the group. There might be a separate insurance company, there might be a separate transport company, and so on. Now, all those trades between members of the group are eliminated from view in the overall consolidated accounts of the multinational entity as a whole, the public interest entity. And that means we don't see large quantities of the transactions that are undertaken by these companies in that overall view. And therefore we actually do not get a fair representation of what is going on within it, only what is going on between it and the rest of the world. But what goes on within it is very often of as much importance to us, whether as employees or whether as suppliers and customers, who of course deal with the subsidiaries, or with regulators who want to know whether money is being moved across borders, as do tax authorities, and of course as do we within civil society. So these accounts do not give a true and fair view of the overall activities of the organisation that they pretend they represent, and which only anyway represent a decidedly selected view of the transactions of the organisation as a whole, really for the benefit of just one group, and that one group is, as I say, the suppliers of capital. And the reason why it's only really for their benefit is that actually it's the group parent company in isolation, not as a group parent, that pays dividends to the shareholders. So they aren't interested in the group accounts as such. They're only interested in what can actually be paid out as dividends by the parent company in its own right. But the group accounts do provide the assurance to, well, one very dominant stakeholder group, and that's the bankers in society, because they want to know what assets are under the control of this group that they can claim if everything goes wrong with their loans. So yet again, we have a worldview that is dominated by the interests of bankers, with the rest of us having to make good with whatever they get. That, in my opinion, is not enough. And that's going to be the basis of a submission I am making to the UK's Financial Reporting Council this week, which argues that we need a whole new view of corporate financial reporting in the future to meet the needs of stakeholders, which is something that I'm afraid to say is not what they are offering in their review of that future, where they're offering a continuation of the existing framework of accounting, which is wholly inadequate to meet the needs of stakeholders in the 21st century. This is going to be a long-running one. I will be talking about this more because this is really going to matter as we hold corporations to account for their massive role in society as we move further into the 21st century and have to face the challenges that it will bring. Thanks for watching. If you're interested in what I've been saying in this video, please subscribe. There is a button below the viewing screen. If you're interested in what I have to say on Twitter, I'm at Richard J. Murphy on that medium. If you want to look at my blog, that's taxresearch.org.uk. And we have a Facebook page as well, Richard J. Murphy. So one of those things will get you more information on what this video series is about, and I hope I'll see you again soon.